Hi there everyone, Rob McGregor here on the 27th of April with our end of March edition of On Track. Recording this at about 10:20 on the 27th and it's a Monday. Another beautiful day on the Sunshine Coast, and I must say during this very strange period I feel very grateful to be living where we do, and I know we have clients all around the country and some around the world, so I hope everything is going as well as it can for all of you. Interesting times. We're going to talk a lot about what's going on. I'm going to spend a lot of today's session on what I would call the fundamentals. And when you get the fundamentals right in anything, it doesn't matter whether it's sport, business, investing, you'll tend to do better than most people who tend to waver from the fundamentals. I'm going to go with a format. I'll start with, as always, a general advice warning. So this video is recorded monthly for clients of McGregor Wealth Management, and in particular those that use the CARE methodology and CARE investment process. It may be useful for other people, but you shouldn't act on this without seeking advice. And for our clients, if anything comes up out of here, give us a call if you feel the need to act on any of the things we talk about. So today I'm going to cover some economic news. There is really only one economic news, which is coronavirus and what happens next. I'm going to put into context. I'm going to talk about some key attributes, some key natures of the market and the economy, and as always, look to a bit of historical context on these things. I'm going to update you on what's happened in each of the key markets we're at so far, and as always, put it in perspective. So the news highlights, and there really is only the coronavirus news. There's a little bit of extra stuff, but it tends to all be related. In this time, I haven't put any economic data up here. Most of the economic data still coming out now is old, and it's completely irrelevant. Last week, they employed unemployment figures, but they were to the end of March, and we had relatively little impact. So while they're interesting, they're not really a guide. So no point in looking at historical economic data at the moment. It's interesting, but it's not going to give you any clues because we're moving very fast here. So if I just replay what's happened so far, we had a mass hysteria response in terms of the markets to an unknown threat. We had a threat that we weren't sure what was going to happen, and different people made it different things. The heart of the threat was a threat to our medical system. Now, often we've forgotten that through this. The virus itself, to most people, not everyone, I'm absolutely aware of that, is relatively not too serious, but it was the threat of the impact on the hospital system and also the threat to the elderly and the unwell. So, and from there we had this whole series of unknowns, and then we peaked into, or capitulated in terms of market fear on around the 23rd of March. And that was right around the time when governments were starting to work out what they were going to do, both in terms of lockdown, social distancing, but also what they were going to do in terms of stimulus. So how they were going to help the economy not die during this period. Now, share markets' peak fear was down around 36% from their tops. But as we went into this crisis, we were off the back of a very good year where returns in key share markets around the world were up around 20%. They went in crazy territory, and that's something that has marked this downturn. It's very different from the past, which I'll talk about more. We're a little bit expensive. We'd had a good run, but we weren't in a financial boom with crazy markets going on. And that has made a difference to what's happened post that sort of downturn. Now, governments then released their stimulus details. So we had governments announcing spending, and we had the federal reserves. The Reserve Bank in Australia is our federal reserve, announcing massive stimulus. So the summary of that stimulus was one, in Australia and around the world, forms of job subsidy. There was free money or helicopter money. In Australia, that was the PAYG tax relief. So all businesses of certain sizes got to not pay their PAYG tax for the next 6 months. So minimum boost of about 20,000 to small businesses, a maximum of about 100,000. So for small businesses, that is vital, and that helps them keep people employed. And then when you add JobKeeper, which was only for companies who were down 30%, roughly speaking. They got that subsidy. So all that has helped. And as we saw these responses around the world, the market's fear subsided and the market jumped 20%. Now, 20% doesn't bring us back to anywhere near where we were. The maths of downturns and crashes is not symmetrical. In other words, if a market drops 50% and then goes up 50%, it's still 25% below where it was. If a market dropped 35% like it here and jumps 20%, well, it's still roughly 15% below where it was, 15 to 20. So you need a jump twice as big to get back to where you were, roughly speaking. But either way, we have definitions that we use. Bear markets are drops of more than 20%. Bull markets where we run up by more than 20%. So this, if the market stays above its lows of March 23rd, and I think it will, no guarantees. I've put lots of question marks here, but I think it will, and we'll talk more about why. It would make this the shortest bear market in history, down 36%, and the quickest recovery to bull market in history. Now, in some ways that makes sense. I know there's plenty in the media predicting that we will retest. There's some very, very bearish people out there. But as usual, you can find so-called gurus to tell you whatever you want right now. So if you want to be really fearful, you can find people that will tell you the world's going completely negative. And if you find people who want to be super optimistic, so you can find those as well. I like to think we strike a ground in what I'd call realistic optimism, and it's trying to look at reality and not be either delusional, pessimistic, or delusional, optimistic. We'll see how we go. And the big distinction about why I think it's valid that this may be the shortest bear market in history is because we weren't in a financial excess, a financial boom before we started this. So the banking system is in great shape. Banks are in really good position. They're able to say, don't worry about your payments for the next 6 months. You contrast that to, say, the GFC and other financial crisis where banks called in debt. They went from extremely loose credit where they lent money to anyone for anything, both the GFC, but every other boom in history. Banks go crazy lending money to people, and then they rip it all back. So we don't have that happening this time. So that is likely to keep this thing short and under control. We've had a few other things thrown into the mix here. The oil price war between Saudi Arabia and Russia right at the start of this sort of pushed us over the cliff. We're still seeing very low oil prices, some crazy prices. The Australian government is using those crazy prices to stock up reserves, which is a great idea. And I think they're almost buying oil for nothing as long as they can store it. And that's a futures market, so it's not a real market. All I know is we're seeing low prices at the petrol pump. Now, for most people, that's really good because it means we've got less to spend on petrol. That means we'll spend more on other things. So the only thing it's bad for is the energy sector. But initial reactions to lower oil prices in the market are often negative because the energy sector in some places, particularly the US, is fairly large. And I'll talk about that a bit more in context of the market. The curve, the curve of new cases, which the mission for governments and the medical system at the start of this was to flatten the curve. Once again, because the biggest risks was that there would be too much pressure on the medical system at one time. If we let this thing spread, the 10% of people that would become critical and need hospital attention would all need attention at the same time, and that wouldn't be possible. So by flattening the curve and just having this come out at a steady pace, that would take away that threat to the hospital system. Well, in some countries like Australia, we've not only flattened it, but we've killed it. The curve has come all the way down. In other countries, the curve has been flattened and is coming down bit by bit, like the US, Italy, Spain. And that has taken pressure off their hospital systems. They're still working hard, don't get me wrong, but the pressure of it exploding and there being no beds available for people, not only with the virus, but with other things, has diminished, except for some very rare exceptions. We saw footage of New York and Italy of where they had to start worrying about beds and the death counts going through the roof. It's really important to remember the way the media works in this. And once again, I'm not diminishing those events at all. But the media points the camera at the worst stuff they can find, then they keep showing that for as long as they can. Cast your mind back to the floods in Queensland where we had the cars floating down the main street of Toowoomba. And they showed that for the next, pretty much the next month. And people thought Queensland was still underwater when in fact, within a week, sun was out, rebuilding was going on. And the media does this in every crisis, whether it be a weather event, a geopolitical, they will extend it out for as long as possible. So they will point their cameras at the worst hospital crisis they can find right now. And the big ones were Italy and then New York. And they'll keep making it feel to the rest of the world like that's still going on, but it's actually not the case. And don't get me wrong, they're working hard, but it's not in that crisis, and the curve has been flattened. In Australia, we saw Virgin go into administration. The Morrison government, quite rightly so in my opinion, decided to let the market work this out. I've got no doubt they would have stepped in if no one wants to buy it. But I believe there's up to 9 potential people that may buy Virgin. Virgin has been revealed to have massive debt. And like a lot of businesses, anyone who went into this crisis in bad shape and who was affected on the front line, travel, hospitality, etc., they're going to struggle. Someone will buy Virgin. It has a good brand. It has all the infrastructure set up so that the existing shareholders will lose all their money. Some of the bondholders will lose money there. They may recover some of theirs, and the government may end up backing some loans. But there's quite a few syndicates looking at this, and I expect we'll get a newer, improved Virgin. It might not compete in every sector, and it might not do some of its international travel, but at least hopefully we'll have 2 carriers in Australia to keep enough competition and variety around. So the $1 trillion question, what happens next? I wish I could tell you, I wish I knew. But we can look at history and market psychology and what other people are looking at to give us some clues. The what happens next for a lot of us, we're looking at what happens with lockdown. We're starting to see some relaxations, very minor as I speak, in some parts of Australia and some parts of the world. Some countries like Sweden didn't go into full-on lockdown. They have flattened their curve, but it's still got a high number of daily cases, but they also massively released a lot of hospital beds, so they're letting the herd immunity thing happen. So we have a fascinating social experiment where we've got 2 relatively small countries, New Zealand, who locked down early and hard, and Sweden, who's sort of let it go, but responded with social distancing, minimal crowds, so less than 50, but apart from that, work as per normal. So we're going to get to see what happens in both those countries. We're seeing it live. So that will help give us the path for coming out of here. Because for countries like New Zealand and Australia where we've smashed this, the medical system is now worried what happens if we release too early and it comes back. And we don't really know how much immunity is built up in the population. It's probably higher than anyone thinks. But yeah, there's a lot of unknown. So I suspect we're going to have slowly release us from lockdown. I think that will be in a few phases. Firstly, the outdoor phase that we're seeing in Queensland, where we can get out and do a few more things outside. Then we'll get the indoor phase where they'll open up restaurants, cafes, maybe bars, but with crowds of less than 50 and 100, and no interstate or overseas travel. Then hopefully we get an opening up to Australian travel, and potentially for us and New Zealand, travel within our 2 countries. And the last bit will be opening up to overseas travel. Now, you can't put timeframes on any of those things. It depends on what happens with treatments. If they find treatments that diminish the effect of people catching this, that will help. Vaccinations are in testing at the moment, in human testing around the world, including Australia, Oxford University. And if we get a vaccination that works, that will speed up that international travel. And the other bit is testing. If we get testing sufficient to know that we've built up reasonable herd immunity and people know whether they've had it or haven't had it, that may lead to some relaxing of overseas travel. But for the foreseeable future, it doesn't look like there's going to be much, if any, overseas travel. And once again, very grateful to be living in Australia. And yeah, it wouldn't be so bad if Australia and New Zealand opened up their borders and allowed us to have holidays within Australia, and that would help soften the damage to the Australian economy of not having overseas tourists come to us and overseas students, etc. So that's a $1 trillion question. Let me start to put this in perspective, but that quick reminder of the theme that will follow is be fearful when others are greedy and greedy when others are fearful. We've certainly seen anyone who at that peak fear decided they were going to buy up has done well. Remains to be seen if they've bought the lows and where we go from here, but there's a fair chance that they have. So just a quick reminder, I'll do these quickly. The 4 pillars of a great investment strategy. And I'll do these in different orders, but I'll start from the bottom. Having a plan is so critical. If you have a plan, you know why you're having your investments, and you get to manage well during these things because your plan is based on your goals. So particularly around that liquidity, which comes through in our reserves process. So none of our clients that run the care process have had to sell any growth investments to fund their lifestyle. Now that's critical, and they have enough in those reserves to fund anywhere from 3 to 6 years worth their lifestyle, which allows time for markets to recover. So not one of our retired clients has had to sell anything in this time, and by nature our working clients are adding to their investments. So planning, critical. Modern portfolio is just doing it properly. The boring stuff, diversification, asset allocation, I'm going to talk about that, rebalancing, which our investment committee has done on a regular basis. Those things, that one's how it should be done in theory, but the challenge is investors make bad decisions driven by the mess it up things we talk about. And part of that is because they haven't learned from history. So I'm going to spend a bit of time today around that historical context, but also the investor behavior. The framework that we use, which has held up well through this, is markets go through 3 main phases: the boom, the bust, and the wall of worry. This was the first time in history we didn't get to the peak of boom. We're at expensive before we came into this, wall of worry expensive. That is a good thing. That means this downturn won't be as bad as when we've gone from extreme boom to bust. That's my opinion. There's some that would think differently, but most of those people thinking differently assume that this will be the same as the recessions that have happened after we've had great booms. I'll talk more about that as we go through. So the mess it up, I won't go through all those, you can read those, but the ways that people mess up their investing are many and varied, but they fall into a lot of these categories, mostly driven by emotional responses to the media, where we make short-term or single issues the focus, when in the long run there will be no focus at all. And I go back to things like Y2K to realize that I hate to think if Y2K hadn't happened in the modern social media world, it would have been a lot different and a lot more volatile. But we tend to get obsessed with short-term things, and make no mistake, this one is a big short-term single issue obsession. It's certainly the biggest of my lifetime in terms of the consequences. It pales into insignificance into the big global wars we've had, the real wars where, in World War II, 50 million people died around the world. I don't like getting too political on this, but I will say that, and you've heard me say this before, we live in the best time ever on the planet, on every measure you can think of: crime, poverty, disease, everything else. But it appears that a large portion of the population always needs a crisis to make it feel like they're not in those great times. And it's good to remind ourselves that we do live in the best of times. This crisis, while being big for us, pales in comparison to previous global crisis in terms of the actual real-time impact. So let me talk about the psychology of the market, because I'm going to show you the economics behind the market in a minute. And the economics behind it's pretty boring, but the psychology exaggerates everything. So on the right here, we have, up until 2019, the 8 worst share market declines since 1990. So it shows them ranging from 21%, which is just over that technical definition of the bear market. And these are declines over 12 months. The one we've just had, these are declines peak to bottom. So the one we've just had fits in at about number 5 or 6 at the moment. So we're going to see the 21% from 1989 drop off. And if we stay where we are, and that's a big if, but this one will come in at number 4. So, and once again, you'll see, if you have a look at the recovery from these downturns from the bottom, in every case except for the most recent one, the share market in the next 10 years has risen between 100 to 200%. So that's not bad. So double means in the next 10 years, you've got a 7% return. 200% means you've got closer to a 15% return. Now, the only one of those that's different is the 2007 GFC recovery to 2017. We recovered, but the market wasn't up that much. And that's why we weren't in that boom that I talk about before we got this correction. And that's why potentially this one will be the shortest and sharpest. So at the moment, you can see on the left, from top to bottom, we were down about 36%. We're currently down about 27% from where we were. So call that a 25% off sale off the share market. We're only down 13% from a year ago, which is important. So investing is a long-term game, and I'll show you some longer-term returns shortly. But we're only down 13%. That's in the Australian share market, by the way. Because you all have very diversified portfolios, there's no individual portfolios that are down that much because of the diversification that we get. Now, the reason we get the violence in the share market is because the pendulum of psychology swings from fear to FOMO. Now, sometimes during the normal wall of worry, those swings are very small. We worry a bit, then we get a bit excited. But once every 10 to 20 years, we get the pendulum swing all the way up to FOMO, so the greed. And that's the fear of missing out, and that's where people are more worried about not making as much money as their relatives, their neighbours, their work colleagues than they are about losing money. So it's a very rare event. It doesn't happen that often, and it normally happens when most people have forgotten about the previous incident. So the last account of FOMO for us was in the 2007 boom that had run very hard. We weren't in FOMO in this case. We might have seen FOMO in things like Bitcoin, and there's often other markets experiencing it, but we hadn't seen it in the share market since 2007. And before 2007, we hadn't seen it for a long time as well. So true FOMO is pretty rare. We got too expensive this time, and people are starting to worry a little bit about markets being a bit expensive, but it's not the same as when people get greedy and start buying, usually with borrowed money, like there's no tomorrow. We weren't in that position at all, and that's a good thing. It's going to make this downturn probably less violent, less horrible than some of the other ones. So eventually we swing to fear. And this was the first time we had a bear market where we got to fear, where we hadn't come from FOMO. But make no mistake, around about that week, the 20th, 21st, 22nd, 23rd of March, that was peak fear. It's normally marked in a cycle by capitulation, and you can see how quickly the market was dropping in that time. Now, markets hate the unknown, and at that stage, they had no idea what was going to happen. They'd worry about it and shrugged it off towards the start of March, as all of us did. But then as it started to spread, then as we realized we were going to go into lockdowns around the world, the market couldn't work out what's going to happen. When the market can't work out what's going to happen, it goes down because people get out. Not long-term investors, by the way, but traders, speculators, etc. That includes hedge funds who make their money from shorting the market. So we had a lot of these people putting their bets on, which pushes the market down further. And that was only stopped when the government stimulus that I talk about was announced. And that government stimulus meant the share market went, this isn't going to be that bad, we can start to go up. And you saw the very big jumps off the bottom straight away, relative, as that stimulus was absorbed. And then as it's continued, and then as we've seen better news on the curve, we've seen an increase. We've got a little bit of sideways happening at the moment after that initial jump. And that's while the market is working out, well, hang on, what's the economic damage? And that's what I'm going to spend some time talking about in a couple of slides, because that's what we're focused on, because that economic damage will tell us how long this recession that we're in, and make no mistake, it's not official yet, but we're in a recession, how long that will be, and how long we get back to a growing economy. And I'll talk more about that in a minute. Before I do, I just want to talk about how important diversification is. The dark blue line on the right side there is the Australian share market. But the chart, which is on the back of the index chart, for this year's anyway, looks at international equity markets from 1970. So to the end of 2019, it's pretty much close to 50 years. It's 49 years. And you'll see the average returns via country there. Look at Hong Kong, 15% average over that period of time, which takes $100 to 116,000. Now this really does show up the beauty of compounding interest. If only we all started earlier. $100 to grow to 100,000 with a 15% return. Most of the rest of the share markets, the major share markets on this chart, are between 10 and 11-ish%. Australia's on the bottom of that at 9.9, but there's a simple reason for that, and it's not that our share market hasn't done well, but this is the returns to Aussies in Australian dollars. So the Australian share market during that time, in 1970, the Australian dollar was $1.10. It was fixed. So someone that invested back then, they got $1.10 worth of US stocks, and I'd say the Hong Kong dollar would have been extremely low. So what's happened in the 49 years since, the Aussie dollar at the moment is about 63, 64. So almost half what it was then. So a lot of that return, particularly from US markets, which is the red, 11.4, to Aussies has come from that falling US dollar. So currency is very important at the moment. Currencies, you get currency hedging just by owning lots of different countries. So that gives a natural hedge. The US does dominate, and the GPS Wealth Investment Committee is spending a fair bit of time at the moment reworking our hedging strategies going forward. Watch this space, but we'll probably have more hedging in just because the dollar's lower. We always have some hedging in, but with the dollar touching below 60, and by the way, it's back to about 63, then we'll probably make some minor adjustments around that. So by someone diversifying across Australian shares and international shares, they get a far better result than just Australian shares alone. And the Australian market, I see a lot of independent retirees who don't get advice. When I see their portfolios, they're often dominated by Aussie shares and cash, and Australian banks, in particular in the Aussie shares. So at times like this, where the Aussie share market has hurt, and particularly some of the banks have hurt worse than the broader market, they'll be questioning their whole portfolio management. And I think they're in a bit of trouble going forward, because I don't think the banks are going to grow like they used to in this low interest world. They're not in any trouble at all. We all own some of them as part of these diversified portfolios. But I'm talking about the people that got the free ride of the banks from the early 90s actually, all the way through, where we had nothing but falling interest rates and we had no recessions in Australia. So it was glory days for our banks. And it may well be different going forward. We will see. I want to remind us all of the three ways that people lose money on the share market. And there is only three. They're exaggerated by gearing. So if someone has lots of debt into the share market, they're more likely to do all of these things, or they'll suffer more from all of these things. But the three ways are, firstly, people that panic and sell when the markets are down. We haven't had any of our clients panic and sell, which is a good thing. There's been a few people worried. That's understandable. Everyone gets worried in this time. I can tell you on March the 23rd, I was worried because I couldn't see where this was going to end. And we saw the Federal Reserve, in particular in the US, step in and underpin the bond markets, which always helped the share markets. And that was the start of that bottom. So there was relief at that stage. But certainly when markets are down that much, it's pointless panicking and selling, because you inevitably miss out on a strong rebound. And every one of those major downturns has a strong rebound. Doesn't take it all the way back up. But if you miss out on that, you're then playing a trading game of trying to second guess what happens next. And if you're trading and you want to do well, you have to make two perfect decisions. One is when to get out, and the other is when to get in. It's hard enough to make one of those, let alone two. And one of the challenges for people that got out somewhere getting down, they now have to work out what they're going to do to get back in. And some of them are waiting for a second wave down. What are they going to do when the market jumps up some more? And even if we get a second wave down, they probably won't invest then, because for us to get another wave down from here, we have to get really, really bad news. Worse news than we can even think about right now. Worse news than we've expected, because just just it happening as per we think is just a flat line for the market. It might even be an increase. So we'd have to get worse news. So number one, panic and sell. Number two, have to sell. And this is where the reserves or the liquidity for our clients becomes so important. In the lead up to this downturn, we and many of our clients were questioning how much reserves we should hold because we're only getting 1% or thereabouts in interest. While there was 20% share market growth last year, so people question that reserves. But an episode like this points out why we have them, which is so that we don't have to sell. Because if you don't have to sell these downturns, you win. You get to enjoy the good long-term returns that happen. So if you don't panic and sell, and you don't have to sell, and you're truly diversified, which is the third one, you will win in the long run. And by having enough liquidity in the reserves, that gets you through that 2 to 3 year ditch that happens in these times. So the next question is around economics. And should we be scared of recessions? You're going to hear the recession word a lot. There's speculation we're in a recession at the moment. I think we absolutely are. A recession is just 2 consecutive quarters of GDP contraction. GDP is the output of the economy. And you'll see from this chart, the chart on the right shows the GDP in today's dollars, in billions, and it's pretty boring. It's not very wobbly. Compare it to the blue line on the left, which is the Australian share market, which goes through complete violence up and down. I'm going to talk about the difference between those two things. But if you looked at the GDP chart on the right, you can hardly see the recession. So let me help you out. X marks the spot here of recessions. Now, technically, 2007, the one on the right here, was not a recession in Australia. We just avoided it, but we only avoided it because we were in the middle of a mining boom, or at the end of the mining boom. So mining economy was growing strongly, so we dodged a bullet. We also had the Aussie dollar fall, so tourism and things like that were strong. So we didn't quite hit recession. The last recession we had was you've seen Paul Keating photos everywhere lately, but that was the Paul Keating recession we had to have, which was quite long. Now you see on the left chart, the light blue shades are periods of recession. So that recession of the 90s went for 3 years. So, and you can see that there, but it's flatline to no growth. So recession doesn't mean the economy drops from the sky. It just means no growth. So if the Australian economy is like someone earning good money and they were earning $200,000 a year, they just didn't get any pay rises for 3 years. Now they still spent $200,000 a year. They dropped slightly, but it's not actually that bad. So recessions are bad for the 5% of people that become unemployed or lose their businesses during that time. For most of the rest of the economy, they're not that bad at all because we get lower interest rates during every recession as governments attempt to boost the economy. We get things like lower petrol prices. So those of us that still have our jobs or our businesses or our income in place when we're retired actually have more money to spend. So we're actually fine during a recession. So for most of us that aren't directly impacted, we don't need to fear a recession. I'll show you more about that in a minute. For those that are directly impacted, those that lose their businesses, their jobs, absolutely they're impacted. They're the ones that feel the brunt of these things, and they're the ones feeling it now. The blow's been softened in this one because everyone on New Start allowance is getting an extra $550 a fortnight. So we've got this so-called living wage where anyone on the dole is getting $500 a week. There's no income tests up to a certain point, so someone can have one partner at work and the other partner getting the dole. Now, these are things that won't be sustainable or sustained, but right now they're a good thing because it means there's money flowing through the economy, which helps minimize the economic impact. I just want to point out a couple of things. If you have a look at the left-hand chart, the index chart, and you have a look at where the recessions are and where the markets are, but the markets bottom early on in most recessions. So there's only one conclusion you can take from that. And this goes back throughout history, that history shows recessions are a great time to be buying shares. They're a great time to be investing. And the reason for that is simple, but I'll just point out first, the market and the economy are not the same things. The economy is on the right here, the GDP, it's pretty boring. Now there's lots going on under the bonnet there. There's winners and losers as the economy moves around in different cycles. At the moment, retail in the the current retail statistics are up 9%. That's huge. That's going to soak up some of the areas where we're seeing downturns, tourism, etc. But there's always winners as well as losers. So the media often talks as if, and people often talk as if the market and the economy are the same thing. They say, oh, we're in a recession. That's a bad time to invest. Yeah, no, it's actually a good time to invest because the market predicted the recession. The market knew we were going into recession, as it always does, because as people start to get fearful, that fear is there because they're not sure what's going to happen, which normally needs... The market doesn't predict all recessions, by the way. Sorry, the market predicts all recessions, but all of its predictions aren't always true. In other words, the market often thinks there's a recession coming, but it doesn't come. But we tend to have downturns every time. But the big difference between the market and the economy is that investor behavior, that psychology, that pendulum from fear to FOMO. So if the economy was reflected in the market all the time, the blue line that is the share market would look like the blue line that is the GDP. But we have violent periods where we go into FOMO, followed by fear, and then all of the wobbling of the wall of worry in between. So that's why this context and this framework is so important. It helps us understand things. And if we understand things, we can make better decisions. They're still scary at the time, but the decision to hold during this time will prove to be the best time. There's some other things we can do for those that have good cash flow, whose businesses, whose income streams, or whose jobs are going well. And I'll talk more about that. So let me get into the markets now, and I'll walk through quickly. Peak to trough, and this is to the end of March. We've had some good recoveries to there, but the market was down 36%. You can see in the bar charts on the left here, the March month for us was down 20%. For the year, we're now down 14% to the end of March. It's close to that at the moment. Our assessment of the market, we rated the Australian share market at the fear level. At the end of right at the bottom of the market, we now rate the market as cheap. Cheap doesn't mean it goes up. It just means for those that have got a long-term time frame, the buying will be good. Sometimes markets can be cheap for a long period of time. Sometimes they can be expensive for a long period of time. The difference is never useful for trading or short-term decisions, which is why we don't trade off these things. But it's a great time for long-term investors who are buying good quality assets. And the market's cheap. How cheap depends on what happens to company profits. And there's two schools of thoughts out there in the predictive space at the moment. You've got economists who are seeing economic data from the top down. So that's what's the economy doing. And then you've got individual company analysis looking from the bottom up, what companies are doing. And they've got very different views at the moment, because when you look at the economic damage right now, it looks pretty horrible. But keep in mind, it's small relative to the market. But a lot of company analysts are going, well, you know what? We can see that ahead for some companies right now, they're actually making more money. For other companies, this will be a hibernation and they'll be back to business. There are some companies that will suffer through this. They tend to get taken over by other companies, or their markets get taken over by other companies, because human behavior 101, we tend to spend most of our money. So we'll spend it somewhere. And we've seen that spending move from normal spending, holidays, off to toilet paper, to groceries, to gym equipment, to home computers, to home renovations. People are spending their money, and that's the people that don't fear that they're going to lose their job. But that's 90% of people. So most people are spending their money. I noticed some of my retirees have cut their spending, but they're not really cutting their spending on day-to-day life. They're just acknowledging the fact that they won't be doing expensive holidays this year, and therefore the spending comes back a bit. But most of us are still spending well, and in some areas we're spending more on things like gourmet takeaway foods, organic groceries, all those little things. Those businesses are booming. So the Aussie market at cheap, you see the long-term perspective of the Aussie market there. That goes way back to the 80s, just to show once again that boom bust, wall of worry, boom bust, wall of worry. And we're at the cheap end where the wall of worry starts, which is normally the best time to be investing. So US shares are fascinating. They were down roughly 26% top to bottom, only down 9% for the month of March, but that's purely because of the Aussie dollar. So the bottom right-hand chart shows the Aussie dollar starting the year at 70 cents, and it was still pretty close to that. Well, it was at that in January. So when the share markets fell, and the US market did go down about that mid 30% as well, But because the Aussie dollar fell at the same time, that cushioned the blow for us Aussie investors. So for the month, only down 9%. Now that's critical for diversification. So if you've got a portfolio that's a mixture of Aussie shares and international shares, you've got way less downturn in this case than either one of than the worst one will ever be. And that's why diversification is so critical. US small caps look a bit more like Aussie shares. Small caps tend to suffer more when we get a bear market like this, but they also grow the strongest in the long run. And the only time they don't grow the strongest is during the bear market. So we saw that. Their top to bottom is about 36% as well, down about 18% for the month. Now cheap, which makes them good buying and very important in the portfolio. One of my favorite parts of the portfolios is an ETF we use called IOO, which is the top 100 companies in the world. Now, if you have a look at the holdings here in the bottom right-hand corner, many of you may not have looked under the bonnet of this, but these are companies, there's a lot of tech in there, Microsoft, Apple, Amazon, Alphabet is Google, and then you got Intel, which is in all our computers. They're actually booming their sales right now. So they're doing well. So that big end of town, they won't always do well, and some of that spending may get pared back when people get back to normal. There's also some Procter and Gamble, Johnson & Johnson, some compute and Nestle, which there's not much in there that's going to go wrong. And even JP Morgan is in fair condition this time around. So those big companies around the world aren't doing as badly as, say, the small companies just because of their sheer might and because they're also in sectors. So still cheap, not quite as cheap. We're actually calling that moderately cheap, so not quite as cheap. But everything's on sale at the moment. Emerging markets, down about 11% for the month, about 5% for the year. Hasn't been a great couple of years for emerging markets. Over 5 years, about 3%. 10 years, 4%. Long-term historical does well. You saw that long-term chart of Hong Kong, which used to be an emerging market. It's not anymore. But I thought I'd throw in a few extra graphs here. If you look at the top 10 holdings here, and some of these are companies you'll know and some you won't know. But you've got things like Samsung doing well, like Apple. Alibaba, which is like the Amazon of the East. Taiwan Semiconductor, that's like Intel. Bit of banking, China Mobile. So some companies that will be doing well there. But these have become very cheap because we fear more for emerging market economies. And you can see the breakup of both sectors here. So about 36% of emerging markets, share markets, are in financials and IT. And then consumer discretion, communications. You have to go a long way down before you see energy, which is obviously with the oil being down. But also, tourism and things like that don't appear materially in these things. So they're gonna rebound well. And when the psychology comes back to normal, away from fear, we should see good, strong rebounds in emerging markets. You see China and China at 40% of emerging markets, then Taiwan and Korea, India and Brazil, and all those countries will return to good growth once we pass this episode. Gold, gold's been amazing. For the year, it's up 43%. It's such an important part of the portfolio because it does act as a hedge during these times of fear and wall of worry. It's interesting, I went back and updated my long-term historical numbers. So gold back to sort of 1970 in Australia has only had a return of about 5%. Its 30-year return about 6.7%. But gold does all its best performing usually when markets are doing their worst. And once again, that's why diversification is so important. Having some gold, having some bonds, having international shares all makes your returns more stable, which I'll get to right now. So while this doesn't look fantastic, it gives you some perspective. So keep in mind, this is at the end of March. So markets have recovered a bit more since then. So this will be the worst measurement in the cycle. So if you start at the right at the 5 years, they're all pretty much the same. They're all around 3%. So what you see in a major bear market like this is all the growth stuff comes back to the pack. In fact, if you look at the 1 year column here, the more growth in portfolios, the worse they've done, which is like because the share markets are down, and the more conservative the portfolios, the less worse they've done. And we see that across now all the periods. Not quite for 5 years. For 5 years, particularly the C, the A, and the E. So in care, we've got our core funds, and the high growth fund is slightly less than the others. Perfectly logical. If we include the A and the E, the rest of the growth portfolio, we'll see the growth portfolio is still ahead, and that's partly because of the active portfolio has done well with gold in it and IOO, and it's also because in the E we have managers who are conservative and they earn their money during this time. So portfolios are doing exactly what we'd expect. At our investment committee a couple of days ago, we benchmark to the rest of the market, and we're still sitting in that top quartile area for comparable funds. Platform providers are telling me our clients with which I know this from looking at your own portfolios, our clients with reserves have weathered this really well compared to those people that just have. If you look at industry super funds through this, most people in industry super funds are in just say a balanced approach. Now, when you're taking a pension payment from a balanced industry super fund, you're selling shares. So while we don't have to sell shares where we've got the reserves, they have to sell shares. So anyone in industry super fund taking a pension right now is selling shares. Now, industry super funds also don't always mark to market their unlisted investments like property and shares. So potentially they have much further to fall because they ultimately own the same companies. But yeah, we compare very well to all of those funds at the moment. All we're ever trying to do is be above average, which we've done consistently, and most of the times we've been in the top 10 to 20%. So this has been a good test for us to go through this downturn. We're very comfortable the way the process and the investments and our investors have handled this. We've had relatively little panic. Our clients aren't selling any of the good stuff to get through this, which means they'll win in the long run. So well done for those of you. Remaining calm. I know it's boring, but boring is beautiful when it comes to investing. And our catchphrase, exciting life and boring money, and not the other way around. I'm going to touch briefly on property before I wrap up. And once again, this is historical. This is to the end of the March, so it doesn't reflect anything yet in terms of the coronavirus. So, the top 5 capital cities are up on average 9% over the last year, as Sydney and Melbourne rebounded strongly, up 14 and 12%. It's only Perth and Darwin that are down. Darwin's got some real challenges. Perth's probably at the bottom of their market and will recover quite well. Units the same, but that will change, and it's important to consider what happens next, and I'll talk about that. This is from Trading Economics, once again historical. Their data is only up to the end of December quarter, and we saw this strong rebound, you can see on the right, in Australian property, particularly driven by Sydney and Melbourne. But if you have a look at the chart on the left, you'll see property market does well most of the time. We have occasional dips. We're going to see another one of these little dips during this crisis. It only applies to people selling their properties, so for those of us that don't have to sell, it's irrelevant. We tend not to worry, but we may see a dip of anywhere up to 5 to 10%, but it will only be for those that have to sell. And then I think we're going to see the sort of recovery that we saw after the Sydney and Melbourne downturn, where it bounces back really quickly. As the economy resumes its normal stuff. Now, if the economic downturn is prolonged, and if it's prolonged beyond the 6 months hibernation, and if people lose more jobs and stay unemployed longer and can't pay their mortgages beyond the 6-month window, then that may affect the property market more. I don't think we're going to be too savage on that. I think we'll get a little bit of that, but I don't think it's going to be too bad. And I think the banks are going to be relatively friendly. So we're not going to see forced sales, which is the real scary enemy of the property market when people have to sell. Because generally we don't have to sell in the property market unless we're in a distressed position. So yeah, that's my thoughts on the property market. I think short term, if you don't have to sell, don't sell. But put it in perspective. Think about why you're selling. If you're selling to buy another property, it doesn't matter. You're buying and selling in the same market, and it might actually be a good time because if you're getting less, you might have less capital gains tax to pay. If you're selling properties to retire and that money is going to end up in a diversified portfolio, you actually might be selling at 5% off to buy shares that are 20% off. So that's not a bad thing as well. So it shows you why you've got to be so careful not generalizing on any of this stuff. You've got to think about your own situation. If you want to talk about your own situation with your properties, feel free to talk to us. because the spread between property and shares is big at the moment. So those who had a plan to sell property, it's not necessarily a bad time to sell now if you're putting that money in the share market. But those who had no plans to sell property, you shouldn't be selling at this time. And the best time to sell for most people with their property investments is during a boom, or where whatever you're buying is in a downturn. The property clock, I'm not going to go through this in long term, and it's interesting to note Heron Todd White have put up, that's their warning in red down there. They've never had that before, but they basically said this is not predictive, it's just a point in time, and no one can really tell the market impact from the crisis yet. So it's good wise words actually, but there's a lot of the Australian property market at the start of the recovery, So if we get back to normal times, there will probably be some very good property buying in the next 6 to 12 months. So for those of our particularly younger clients who will be buying property as part of their plan, I think the next 6 to 12 months is potentially pretty good buying. So particularly if you can buy some of those distressed opportunities. Same for units, I won't go into that. Let me finish with two things. One, bear market survival tips, which you've heard before, edited slightly from the last time. But rule number one, don't panic. You've got a good plan, stick with the plan. For our accumulators, those that are still building their wealth because they're working and not retired, keep dollar cost averaging, potentially bring some of that forward. For retirees, draw down as per plan. You don't need to cut your spending. You might choose to, but you don't need to. You have a good plan. Now, for those that have cash or capacity, whether that be line of credits, etc., this is a massive sale. Now, that doesn't mean it can't get worse, but it's on sale. It might turn into a bigger sale. It might not, by the way. My thoughts are it probably won't get back below the lows that we've seen. It might retest them. It might get worse than where it is now. I don't think it will get back below those. I can be totally wrong on this. No one knows for sure, but it would take some severely bad economic news that we're not expecting. The market has factored in exactly what the market expects right now, so it will take really bad news. So when you start to see the headlines about recession and unemployment, that's already in the market. It won't be new news at all. The media will react as if it's new, and if it's a surprise, it's no surprise. We're already there. So for those that have capacity, you could consider buying. The ways to do that, you could consider moving up one risk profile. So if you're balanced, you can move to growth. If you're growth, you can move to high growth. That effectively buys an extra 20% worth of shares for you. You could bring your reserves down by a year if you're sitting on 4 years of reserves or substantial reserves, particularly if you're spending less money. Retirees are able to reduce their pension payments by half for this year and next year. So that means if they're not spending the money, we can use some of those reserves to actually buy in. So we've done that for some. We're not doing it for all because everyone's in different circumstances. Some people prefer the sleep at night factor of having that money just sitting there to know they can ride through. Others feel the need to be more opportunistic. We just want to make sure no one does anything silly, and either holding or buying a bit more are not silly things. They're quite smart things to do. And for our dollar cost averages, those that are either averaging money into the market, into retirement, or those that are still building their retirement wealth while they're still working, it's a great time to bring forward some of that dollar cost averaging if you have the capacity. The number one tip, turn off the news, get your news from reasonable sources, but do not watch the mainstream media news, or not for 1 minute more than you need to find out what's going on. But enjoy, look outside. There's a lot of good stuff happening in the world. Human nature and ingenuity is amazing at this time. There's some really good stories coming out. I know there's some bad ones as well, but the balance is more good than bad. I'll finish with reinforcing the process. We do title it Exciting Life, Boring Money, and not the other way around. But it rests with very boring but very important principles. Build a plan based on goals and portfolios based on the plan and your goals. Take a long-term view. Always maintain those boring but beautiful things. Diversification, good asset allocation, and enough liquidity to get through a crisis. For most of our investments, we run low-cost index funds. That means we sit well above average in performance because you're not wasting money, any more money than you need on fees. We do have protection against short-term volatility through reserves and dollar cost averaging. The regular rebalancing that happens means we're buying growth markets when they're down. And remember those 3 ways to lose money. We've talked about that, especially today, and I know you won't do it. Thank you for spending the time. I know for a lot of you this has been valuable. We've had really good feedback about this one. I've gone over on this one. I hope to get them back to the sort of 30-minute mark as we get out of a crisis, but I do want to make sure you're feeling comfortable with your investments. If you've got any concerns, worries, or want to take advantage of opportunity, please give myself and the team a call. We're talking with many or most of you. We will be doing our reviews as per normal. But if you want to jump in and talk about something between reviews, as always, please feel free to do so. I wish you all the best through this crazy times. I hope we're doing face-to-face meetings. I've got a feeling we will be in late May, early June, to those that are not in a high threat position themselves. So I look forward to shaking some hands and getting back to some normality over the next 6 months. And I think that we will. And I suspect, like most crises, human nature is very good at forgetting them. Ask any mother. They tend to forget the pain of childbirth. That's why people have more children. If we remembered it exquisitely, we'd never have more kids. It's the same with crisis. If we remembered them in detail, we'd never invest. So it's important that we actually delusionally forget some of these things. But important to remember the key lessons of history, which I'm going to keep reminding you. They are the same. It's important, and our good team applies them daily in terms of managing your portfolios. So wishing you all the best. I'll talk to you on this next month, maybe in between. We may have another update in between. If I feel like it's improving, I'm not necessarily going to do an update. And as I said, feel free to reach out. Wish you guys all the best, and look forward to talking or catching up soon. Rob McGregor, signing out.